by various high courts, which she has tried to tinker with. We will certainly be able to deliberate on those issues. There, I think they can have a very, very wide impact. So I will not take much time because all of you are here to listen to the views of Mr. Sanjeev at the first instance, and then have the expert views of Mr. Ajay Vora and Dr. Punia and Mr. Rastogi. So I think let us start with the deliberations. I'll request Sanjeev ji to start the this webinar.
Thank you, Ashwini ji. And I'm thankful to my colleagues for giving me the opportunity to steer through this, the portion related to direct taxes as envisaged in the Finance Bill 2022, which is a part of the Union Budget 22-23. With the fiscal incentives being rolled out at regular intervals, and with the introduction of GST, the annual budgetary exercise seemed to have lost much of its sheen and the excitement that was normally associated with the budgetary exercise earlier. But as chartered accountants and professionals engaged in tax practice and businessmen engaged in various strata of human endeavor, various areas of activity, we always look forward with bated breath to the broad direction of the economic policy, especially and more importantly, to the areas in changes in the realm of direct and indirect taxes. I will not go into the broad details of the monetary and fiscal policy. Let that be for the economists to deliberate and decide upon as to what direction it will take. But just as Ashwini mentioned, the finance minister, in perhaps one of the shortest speeches ever, barely made a mention to the changes in the indirect taxes. The finance bill seemed to have only 84 clauses, but as usual, the devil lies in the details, and more so this year, where changes have been made which have a profound impact, calling for increased compliance and for calling for SSCs and professionals to always be on tenterhooks as to the kind of compliances, the kind of responses that the department is looking for. While there's been an attempt to resolve certain controversies which have arisen whether judicially or procedurally and to iron out operational deficiencies, the fact remains that the entire burden of compliance and of dealing with the department will likely undergo more complexity and will undergo a sea change. For starters, there's practically no change in the proposed in the tax rates, apart from some changes in the surcharge on dividend income, short-term capital gains, long-term capital gains, and AMT for alternate minimum tax for cooperative societies. As usual, I think perhaps what has become normal for them, the salaried and the middle class have justifiably so have a feeling of being short-charged and wronged in terms of there being no further tax incentives for them, no further rebate in the rates, since they effectively have suffered the most of the severest part of the brunt of the pandemic, and are paying the highest real effective rates of taxation. Be that as it may, that's an area on which we do not have any control, and justifiably the middle class, the lower middle class, will feel kind of unjustly treated with. In the manner in which the entire exercise has been structured, its tax rates have already been covered. The presentation is divided into 6-7 parts, beginning with certain changes relating to computation of income, the deductions, the tinkering with the deductions under various heads, a new chapter, which is an exciting area that has opened up in the light of the recent cryptocurrency and the digitalization of the economy, that is virtual digital assets. A small, maybe innocuous change in Section 68 relating to unexplained cash credits, but which again will have wide ramifications. A new provision included in the Act relating to the availability of an option to file updated returns. Changes in the assessment wherein the faceless assessment scheme is practically gone a total overhaul. And there's some amount of procedural relaxation in the provision relating to reassessment. Taxation of charitable trusts, that is one area, the government has recently brought to bring under the scanner, which we shall deliberate later on. And areas relating to compliances relating to TDS, TCS, and set-off of losses, especially in the case of income arising as a result of search and seizure action. With that, we will start the process from changes to be taken into account while preparing the computation of income. The first issue is relating to disallowance under section 14A with respect to expenditure incurred on earning exempt income. Be that as may, this section, which was introduced about 2 years back, followed by the introduction of Rule 8D, provided that any expenditure incurred on earning exempt income was not to be allowed. Over the years, it has led to a lot of litigation, complexity, interpretational issues, in particular relating to the fact that when there is no exempt income, what would be the quantum of the disallowance, and whether if at all any disallowance would be called for, and what would be the quantum, or whether the disallowance can exceed the amount of exempt income. Now, given there were certain judgments of Delhi High Court and various tribunals which clearly held that in the absence of any exempt income, no disallowance could be made. With a view to kind of maybe, I don't know, overrule the judgments or with a view to settle that that controversy, the law seems to have been amended, is sought to be amended to say that section 14A shall be deemed to have always applied. That's critical. It shall be deemed to have always applied in case where exempt income has not accrued or arisen or has not been received during the previous year, relevant to the assessment year, and expenditure incurred has been incurred during the year previous in relation to earning such exempt income. Before going ahead, let me just mention one or two aspects of section 14A as it would be relevant today. It was brought into the statute book when long-term capital gains and dividends were basically exempt. Over a period of time, because of legislative changes, both have been brought under the tax ambit. So one does not really know as to the extent, the purpose which is being served by the continuation of section 14A, save and except for, I think, share of income from partnership, share of profits from partnership firm, not just totally the share of income. So be that as it may, there is actually a limited applicability henceforth of section 14A. A couple of issues arise, and I'll request Mr. Ajay Vora to give his opinion on the same, especially with respect to the retrospective amendment, whether it is ethically justifiable, legally strong, and whether it's kind of some kind of it portends some kind of a overreach on behalf of the executive and the polity to overrule the functions of the judiciary, and procedurally relating to what would be the position henceforth in relation to when the expenditure calculated as per Rule 8D exceeds the amount of exempt income. I would request Mr. Ajay Vora to kindly give his view on this subject, this topic, and any other issues that may come to his mind on with respect to section 14A.
Thanks, Sanjeev. I think you've summarized the role of section 14A, the interpretation placed on section 14A. In fact, one had thought that the dust had actually settled with regard to 14A, with so many judgments now from the Supreme Court, the High Courts, and benches of the tribunal, which had taken a view that 14A would apply restricted to the quantum of dividend. If there is no exempt income, there can be no disallowance under 14A. And there must be income actually earned during the year. Speaking for myself, I have actually been involved with interpretation of 14A right from the inception, starting with the first special bench of the tribunal in the case of Daga investment. And thereafter, we had an adverse decision from the Delhi Special Bench in Chem Invest, which got overruled by the Delhi High Court and got ultimately approved by the Supreme Court. So one had thought that with, as you very rightly said, now dividend being made taxable, there doesn't remain much scope for, the play of Section 14A. And after the courts have really interpreted and judicially settled what should be the parameters of working of 14A. But this explanation that has been added, which you put up on your slide, that 14A shall be deemed to have always applied in a case where exempt income has not accrued or risen or has not been received. So meaning thereby, as an example, if you invest in shares out of borrowed capital, now in that situation, the dividend may not be earned on the share in the year in which the investment is made. It may come 3 or 4 years hence. Now the question was whether you will make a disallowance in the year in which the investment is made, in which you've incurred the interest expenditure. Originally, the courts had taken a view, the benches of the tribunal had taken a view that the expenditure may become disallowable, the interest expenditure may be disallowed. But what has happened was that over time, with overzealous assessing officers making disallowance under 14A, which far exceeded the dividend income, which may be in the case of an investment company, even exceeded the expenditure debited to the profit and loss account, judicial fetters were placed by the courts on the working of Rule 80 and the disallowance that needs to be computed under Section 14A. Now, the larger question that will arise pursuant to this insertion of the proposed explanation is this explanation prospective or retrospective? I think people, and you also mentioned, people have taken it almost as a fait accompli, as if this explanation is retrospective, because it uses the word shall be deemed to have always applied. So therefore, from the start, this should have been treated as part of forming a basis of the calculation of disallowance under 14A. But interestingly, this explanation has been made applicable from 1/4/22 and not with retrospective effect. So therefore, I think there will be reason and there will be occasion for judicial interpretation of this explanation, whether it will have retrospective or prospective effect. Now, there have been several Supreme Court decisions in the past where similar explanations, starting with identical language for the removal of doubts. Now, the courts have really interpreted that on the basis whether it's a substantive amendment or it is only a procedural amendment. If it's a procedural amendment, it may take retrospective effect. But if it brings to tax something on a substantive basis, then it can only have prospective effect and prospective operation and not from a retrospective date. So I would tend to take the view that this explanation, since it is made specifically applicable from 1/4/22, should have prospective effect and should have the effect of prospective overruling of judgments of the court. Otherwise, it will tend to negating, nullifying the decisions rendered by the apex court in several matters. So, and then the question will arise whether you will, if this explanation has retrospective effect, whether the department will embark to reopen past assessments. So that will be another consequence that may arise if the department takes the view that, to my mind, the view in the department seems to be that we've inserted this explanation in order to undo the wrong that was done to the department. Because the legislative intent always was to disallow expenditure incurred in order to earn exempt income, whether or not income was earned in that year. So this will be now the next round of controversy, and we've actually come back to ground zero. So far as Section 14A is concerned, we will have a fresh round of litigation, which will ultimately again end up in the Supreme Court. So the government is on record saying they will not make a retrospective amendment. Now it remains to be seen how the courts will interpret this explanation. Anything else, Sanjeev, you want me to cover?
No, thank you, sir. I mean, this issue that you have talked about, reopening past assessments, that will arise in a couple of more issues, I think, wherein the similar language has been used. It's been effectively made effective from 1st April 22, but the language of the section says they deemed to have applied, and always, we'll come to that later, maybe in terms of when you're talking about cess or something, cess 40A2. The next issue, which it will be relevant for all of us, is the major amendment to Section 37(1), which is the residuary clause relating to allowability of expenditure, which allows any for the allowability of any revenue expenditure and non-personal expenditure, which is not in the nature of a capital expenditure, for the purpose of calculating income under the head profits and gains of business or profession. Wide explanation one thereto, which as hitherto in force, any expenditure incurred for any purpose which was an offense or which is prohibited by law was disallowed. So far so good. This explanation has been it's been a part of the statute for past some time. Now this explanation, the scope thereof has been proposed to be expanded by making three very vital and far-reaching amendments. One is the scope of the offense for which the expenditure in respect whereof is to be disallowed has been expanded to cover not only offenses which are prohibited in India, but also outside India. Now, that is one. Number two, which is, again, very vital, is the question of where any benefit or perquisite is provided to a person in violation of law or rule or regulation or guideline governing the conduct of such person. Now, with a view to recapitulate the history, this is with a view to, this is talked about, the word freebies has become a part of our, I think, kind of lexicon for the past couple of days. To cover the freebies granted by medical companies, pharma companies to medical professionals, doctors, which were otherwise prohibited from taking any money or any remuneration from the pharma companies, but by way of gifts or, traveling expenditure or the other things. So with a view to govern this kind of activity, this provision has been inserted into this particular explanation. The scope of this explanation has been expanded. Be that as it may, on a plain reading, it seems to suggest that the onus of proving that the expenditure incurred does not violate the conduct governing the recipient shifts to the person who is incurring the expenditure. Now, whether this kind of an onus provided on the assessee, that suppose you are making payments to a doctor or a chartered accountant or lawyer, whether the code of conduct applicable to that person permits him to expect to accept that kind of hospitality or to receive those benefits is something which is beyond comprehension. I would like to have the views later on of Mr. Ajay Vora on this issue, that how can whether it is justifiable for the assessee to determine whether the conduct of the such person in respect of whom the expenditure has been incurred is not violative of that conduct. The third is, and that's again a very critical, any expenditure incurred to compound an offense under any law in force in India or outside India. Now it says, my understanding of compounding is that it's not an admission of guilt, but it's a process undertaken in the expenditure incurred to obtain peace of mind, avoid protracted litigation, and to generally put a quietus to the issue. It is normally done before the offense has been established or adjudicated in a court of law. So compounding of any offense under any law in India or outside India. Now, determining whether compounding of an offense outside India, I think it's relevant, as I heard Mr. Vora speaking also the other day, in case of pharma companies who are held guilty by the US FDA or other regulatory bodies across the world to compound their offenses. So that kind of expense would not be disallowed. So particularly, sir, I would request Mr. Ajay Vora to give us our opinion as to the in addition to what all he would like to enlighten us, but with respect to the second proviso, that is the expenditure incurred which is in violation of the rules of conduct governing such person.
Yeah, thanks, Sanjeev. Sanjeev, you seem to have expanded this second limb to even chartered accountants. I really don't know whether there is any such regulation prohibiting chartered accountants from accepting freebies, travel expenditure. MCI regulations, yes, it is there.
So that is why I asked you to comment, because I am
No, frankly, I am not aware whether there is any such regulation barring or prohibiting chartered accountants from accepting.
I hope there is none, sir. I hope there is none. Yeah.
So as one sees it today, this is meant to bring in the expenditure incurred, especially by pharma companies, for making available freebies, hospitality, travel expenditure, which is not related to the business needs of the company, but actually amounts to making available a benefit or perquisite to the practicing doctor. And that is in lieu of the doctor prescribing medicines, that are manufactured by that pharma company, where there is a quid pro quo. So frankly, in that view of the matter, the courts had taken a view that the regulations apply only to the practicing doctor and the practicing medical practitioner. So that medical practitioner can be hauled up under the MCI regulations for violation of the professional code of conduct and professional ethics. So courts and benches of the tribunal had taken the view that notwithstanding that the acceptance of the freebies by the medical practitioner may be violative of the MCI regulations, but those regulations do not apply to the pharma company, to the giver. It may be morally wrong. It may be morally wrong for the company to, make available these freebies to the practicing doctor in order that the doctor gives a preference to the medicines manufactured by this particular pharma company. But there was nothing in the law to bar the allowance of such expenditure. So therefore, to undo all those judgments, now while the medical professional will, under the code of ethics, not be in a position to accept, which is already there, it is existing, and if he is found guilty, he can be hauled up and his license or his qualification can be cancelled. But that apart, this proposed amendment seeks to disallow the expenditure in the hands of the pharma company, the giver company. Now, the larger question will be that the onus will be on the company to prove that this is expenditure incurred wholly and exclusively for purpose of business. It is not intended to provide any benefit or perquisite to the medical professional. So that burden is now on the assessee, the giver of the freebies or the benefit, to demonstrate that there is no benefit or there is no perquisite given to the person. This is expenditure directly and wholly exclusively incurred for the purpose of business. So suppose a doctor is sponsored to attend a medical conference abroad. Now the company will actually demonstrate how the attending of that conference by that medical professional at the cost of the pharma company can be said to be expenditure incurred wholly and exclusively for the purpose of business of the pharma company, and that it is not in the nature of making available any benefit or perquisite to the doctor. So I think that's the question that will come in. Now the last limb, Sanjeev, again you made a very interesting point that to compound an offense means before admission of guilt. Now I am really at a loss to understand, when you say an offense, does it mean a mere show cause notice amounts to an offense under any law in force in India or outside India? So you will compound an offense without admission of guilt. So there is actually no there is no admission of guilt, there is no conviction. The compounding will be one step anterior to either a conviction or the admission of guilt by the assessee. So when it talks of compounding an offense, now does a mere show cause or a mere section in a particular statute amount to an offense? And therefore any expenditure that you incur where you actually settle the matter, I may not call it compounding. Suppose you settle a matter or there is a plea bargaining. Outside of India, this is fairly common, where people without admission of guilt enter into a plea bargain that the any offense or any conviction will not happen if you make payment of so much of fine. Now one can possibly argue from the side of the revenue that this is to kind of keep away any conviction, a possible conviction under a law, and therefore you've agreed to pay a fine. So this is for compounding of a proposed offense, an offense which has not been established. But assessees would like to argue that an offense will happen only when it is established under the law, and any expenditure or any payment made after the offense is established will necessarily attract the disallowance under this proposed amendment. So again, this question will arise that whether the compounding fee for in response to a show cause notice. In the Income Tax Act, you are aware that, you know, the commissioner gives you a show cause notice for prosecution, and there are compounding guidelines. You
Yes.
compound before they file the complaint in the trial court. After the complaint is filed, they have no power to compound the offense.
Yes.
But maybe at the trial court level, a compounding may happen, or there may be a settlement that may be done.
Yeah.
Now, whether in that situation can one say that this is compounding on offense? A criminal proceeding may stand on a different basis. You may have, you know, a civil proceeding also where you seek to compound the likely offense that is to be established. Now, these are again issues of interpretation, whether this will impact in a situation where there is a mere show cause and the parties, in order to give a quietus to settle the issue, you know, agree to a payment. So whether that will be treated as compounding an offense. And you refer to, you know, pharma companies where this suits across outside India in foreign jurisdictions are very common for patent infringement. And companies then ultimately agree to settle. Somebody mentioned to me that, you know, a patent infringement may constitute an offense outside India. And therefore, in a arrangement between private parties, can you say it is to compound an offense? So that will also be a larger question, that whether it should be an offense vis-a-vis the state, or in a private arrangement between two parties where the other party threatens action saying that you've, you know, offended a particular law, whether that will amount to expenditure for compounding an offense. So again, these are issues, interesting issues that will arise relating to interpretation of this particular provision. So at least the budgetary exercise every year ensures that people like us are not out of business.
Sir, I remember Dr. Palkhiwala, when he used to give his lecture every year, the legendary lecture, he used to always mention that every year the Council of the Institute and the Bar Council should pass a resolution thanking the finance minister to have their kitchen fires burning in a bigger manner, and, you know, so that is why.
Just taking this issue slightly on a different pretext, Ajay ji, in these last 2 years, during this pandemic, on the one hand, we have been honoring our medical fraternity. We have been saying that they have done yeoman service. I do not know in what respect this can be considered an appropriate time to hit them directly. This free, I fail to understand this. In a larger context, I am saying.
Right, okay.
On the one hand, we are saying that they have really done a yeoman service. Everybody was suffering. They came out. We have been saying they are our frontline soldiers. And to make this amendment in such a, which directly hits them only. So otherwise, I feel it was not called for.
Right.
Sir, just a question. A suo moto, you know, before any action on the part of the government or of any body, suo moto effort at, you know, filing a compounding application, what would be the status under this explanation with respect to the same?
I think the larger question will be, you know, the nature of the offense or the likely offense.
Okay.
And I would tend to take the view that when this matter travels to the court, whether the expenditure is disallowable, the court may be required to look into the complaint, the pleadings on either side, to actually determine, you know, whether that was an offense which was established or likely to be established before the expenditure can be disallowed. Now, the compounding can happen at several stages. Like you said, you file a compounding before even a complaint is filed.
Yeah.
You may have a situation where in the midst of the trial, somebody agrees to a compounding. Or maybe at a later stage when conviction is announced, the judge gives you an option to pay so much fine in lieu of your conviction or in lieu of imprisonment. Now, you can have several such variations and nuances. So again, it will depend on the facts of each case.
Yeah. Okay. Thank you, sir.
So as tax practitioners, you will possibly also have to don the hat of a criminal lawyer to understand the nature of the offense and the likely chances of conviction.
Yeah. So that means we need to shore up our, you know, criminal law and other. Yeah. Thank you, sir. So moving on, the other amendment is a clarification on the allowability of cess. Now, over the years, what has become a kind of a regular feature, in addition to the income tax, the government has started levying surcharge, which was an age-old practice, and cess to cover various kind of needs of the economy. Now, Section 48(2) disallows any sum paid on account of any rate or tax levied on the profits and gains of business and profession, or assessed as a proportion thereof. Now, a controversy arose with respect to whether cess levied by the central government would fall within the mischief of Section 48(2). Relying on a circular issued in 1967 by the CBDT, which mentioned that cess was not covered by clause 48(2), the SSC started, guided by some well-meaning professionals, to claim this kind of as an expenditure. The question always remained, in case of an SSC having income from multiple sources, profits and gains, capital gains, etc., how would you bifurcate the extent of cess to business and profession so as to enable him to claim the relevant deduction? This view was endorsed by favorable decisions of the Mumbai High Court, Rajasthan High Court, in the case of Sisago and Chambal Fertilizer, respectively, and followed thereafter by various tribunals across the country. However, the Calcutta bench, in a case of Kanuria Chemicals, adopted a reverse view. A distinction was sought to be drawn between a surcharge levied by the states and by the center. And the surcharge levied by the center was kind of made equivalent to an additional surcharge, so which was covered by provision of Section 48(2). Now, reliance was also placed on a decision of the Supreme Court in the case of K. Srinivasan. So, again, this amendment has been made to clarify.
Calling Srinivasan, mobile.
Has been clarified that for the purpose of 48(2), the term tax includes and shall always be said to have included surcharge or cess by whatever name called on or by after the 1st 1/4/2005. Here again, the question of retrospective amendment comes into play, and I'd like to put to Mr. Ajay Vora 2 questions in this regard. What would be the position in respect of where a claim has already been made and adjudicated by the authorities, by the appellate authority in favor of the SSC, and the a penalty to be whether any penalty, what would the status of the penalty, whether imposable or not, or what would be the ramifications thereof, and as usual, any other issues that may kind of come to his notice, which we might.
Sanjeev, I think this issue with regard to deductibility of cess was being debated, agitated across the country in different forums. The assessing officer, the DRP, by very exhaustive orders, have been disallowing the claim because that's the revenue stand. That cess is nothing but in the nature of additional surcharge. Yeah. It's a different matter that surcharge, as you said, and cess have been introduced time and again on the basis that this is a temporary measure, but they are always here to stay.
Yeah.
So, notwithstanding that we had, 2 favorable judgments from the High Courts, the Rajasthan High Court, against which the special leave petition I was actually defending, that special leave petition came to be dismissed on account of low tax effect. So that Rajasthan judgment almost became final. And then you had the Bombay High Court, which also by an elaborate judgment came to the conclusion that cess is deductible business expenditure, it is not tax, and hence not hit by the bar under Section 48(2). But notwithstanding this matter was being agitated, the Kolkata bench took a contrary view, dissenting from the other benches of the tribunal. And the government has taken note of the Calcutta view as a provocation for making this retrospective amendment, because it was always the government stand that cess is not deductible. So this amendment is one instance where there is a retrospective amendment of this particular provision from 1/4/2005, from the date cess was introduced, in order to undo the favorable judgments from the High Courts and benches of the tribunal. So To answer now your points about the action under 147, 148 for reopening, if the conditions are satisfied, if the jurisdictional conditions are satisfied, the department can possibly, invoke action under 147, 148. Of course, the assessee will have the means to defend by saying this is nothing but a change of opinion if this has been examined or there was no failure on the part of the assessee to disclose fully and truly all material facts. So this retrospective amendment cannot amount to a failure on the part of the assessee. And to answer your further point, this cannot be a case of levy or penalty. So there are favorable judgments from the high courts, from the benches of the tribunal. The assessee took one view. So notwithstanding that cess may get disallowed in the pending assessments or wherever you made a claim, that cannot be the basis of the assessee being visited with levy or penalty.
Okay.
While I am this, I may just point out that this is a case where there is an express retrospective amendment. I don't know how many people have seen that almost the entire proposals in this Finance Bill 2022 are currently applicable for the financial year under progress. The amendments normally, the budget normally would take effect from a prospective date. Normally, the budget would have said this is applicable from 1/4/2023, that is assessment year 23-24, be relevant to the financial year beginning on 1st April 22. But here, the amendments are all made applicable from 1/4/22, which means for the assessment year 22-23, and they are already applicable to the financial year 1/4/21, which will conclude on 31st March 22. So your transactions for the current year may be subjected to whatever amendments have been made in this year's budget. So that's also an aspect that needs to be looked into and examined.
But if that be so, sir, that the position of interest under section 234B and 234C in respect thereof could be material in some cases and could have an adverse impact on many assessees.
Yes, it is possible.
They would have planned out in a certain manner, and all those planning could have, gone out of the, to put it bluntly, gone out of the window.
Right.
Yeah, so that
So
could.
in the last year's budget, Sanjeev, you would have seen the reorganization of partnerships.
Yes.
That almost came in with retrospective effect because it was applicable from the first day of that particular financial year.
Mm-hmm.
Or
Okay.
withdrawal of goodwill.
Yeah. Okay.
Depreciation on goodwill also had retrospective effect. So
Yeah.
although the government is not on record saying these amendments are retrospective, but if you look at the fine print, these budget proposals are already applicable.
Yeah. So that's a very valuable input that you have given us. I mean, I think we kind of in our maybe we've kind of missed that out. It didn't deserve the adequate attention or the So thank you very much. So moving on, we'll move on to I'll skip on the clarification of deduction under section 43B in case of interest has been converted to debentures, because I think we're kind of running behind what our schedule time was. And we'll move on to, taxation of virtual digital assets, which is, I think, to put it, very, it's like the cryptocurrency, crypto assets, digitalization. These are the new buzzwords roaming around in the, in our lexicon again, and have become a part of vocabulary. Just to start on a different note, the RBI governor yesterday made a very interesting statement. Cryptocurrency has no underlying value, not even a tulip. While you could argue with him whether a tulip has, how come he has come to a conclusion that tulip has no value. But that just goes to show the kind of, the negative mind frame with which RBI has all along been viewing cryptocurrency. Now, this budget 2022 attempts to introduce a new central bank denominated currency. It's not yet given the legislation, as far as I understand, has not so far given any legality to the cryptocurrency. But nevertheless, the transactions on, I could be wrong on this count. If I'm wrong, please correct me. But transactions on WazirX and other these exchanges have touched millions, and they've caught the fancy of the young investor community. Now, this budget, very interestingly, and in a path-breaking move, seeks to bring in focus a new framework for taxation of virtual digital assets, which would include cryptocurrencies and non-fungible tokens. Now, it's a very wide topic. It's a new topic. It's an area which we are not aware of, which will have ramifications, and I'll talk about that in the course of our discussion. But virtual digital assets are defined in section 247 in a very kind of an exhaustive manner to mean any information or code or number or token, or not being Indian currency or foreign currency, generated through cryptographic means, through a digital representation, which can be stored or traded electronically, and includes a non-fungible token or any other token of similar nature. I have not tried to reproduce the entire definition because for that it's a matter of record. The budget proposes to introduce a scheme for the taxation of transfer of virtual digital assets. A new section 115 BBH is proposed to be inserted to tax income on transfer of virtual digital assets at a flat rate of 30%, subject to no deduction being allowed except cost of acquisition. That raises a very interesting issue. I'll come to that in a couple of minutes. And no set-off of loss against income on transfer of virtual digital assets. I mean, loss from any other source cannot be set off against income from transfer of cryptocurrencies. And the loss on sale of any virtual digital assets will not be set off against income, other income, and will not be available to be carried forward. Corresponding changes are also sought to be made in section 56 to 10 to cover transfer of virtual digital assets without consideration or for inadequate consideration within the ambit of income from other sources. Apart from that, another section 194S is proposed to be introduced to provide for deduction of tax at source on payment of transfer of virtual digital assets to a resident at the rate of 1%. There are conditions under which this 194S will not be applicable. Now, arising therefrom, a couple of issues which come to my mind. What would be the cost of a digital asset in the hands of the originator thereof? For example, a non-fungible token, a special, to take an example, Amitabh Bachchan selling some, some of his items by way of, on some memes or something on digitally. What would be the cost of asset to be determined to, determine what was the income from cryptocurrency, from transfer of the virtual digital asset? Will it be nil, or what some imputed cost would be imputed there too in terms of what would is time spent in creating that, and so on and so forth? Whether the law permits such kind of imputation of cost in such cases. The proposed section talks of no setup of loss against income from transfer of virtual digital assets. What about loss with respect to in the same year we have a transaction of income as well as loss, whether the net income would be taxable? Third is, in case of transaction of virtual digital assets on an exchange, how would the provisions of section 194S be operationalized and put into force when the transaction is carried out through an exchange, wherein the identity of the buyer and seller is mostly in a vacuum, it's not known to each other? So how would that operationalize? So have we been joined by Mr. Punya Aditya?
Not yet. He said he will join in another 10-15 minutes.
Okay, so and lastly, since we have the benefit, I think Aditya can deliberate with Mr. Abhishek Rastogi more on that, the GST implications of such transactions. So I'd request Mr. Ajay Vora to kind of put his tell us his views on these subjects which I have already mentioned.
Sanjeev, I don't know how much you know about crypto, but frankly, I am a novice so far as that is concerned. I have just heard this name being branded about crypto.
Sir, I am maybe probably I'm worse than you. I'll admit that. But since these words are a part of our lexicon,
they're being branded about, and one reads, and now you even get it in the TV. At almost before the 9 o'clock news, you will have the quotations for there's various kind of cryptocurrencies.
The nation would want to know what are the quotations, you know. So,
So frankly, one will really need to understand the nature of this asset, this virtual digital asset, in order to, exactly opine on the implications of this budget proposal of bringing to tax um, income from transfer of these virtual digital assets. But having said that, I think I would preface my comments by pointing out that the government is today not in a position to comment whether crypto is accepted to be legal or illegal. Leave
yes.
aside that legal tender. I'm not on legal tender. At the moment, I think the stand is ambivalent. If you remember, the Reserve Bank had banned any
Yes.
transactions or trading in crypto. The Supreme Court had set aside the ban, and the matter is still pending with RBI to come out with legislation relating to crypto. So that apart, I think the ethos seems to be of bringing to tax gains from trading in crypto at 30%, almost equating it to illegal business. If you remember, we had the old Supreme Court judgments in Pyara Singh and Dr. T.A. Qureshi, which said that even if you have income from smuggling, from an illegal business, nevertheless it is income which should be subject to income tax. So without taking a stand on the legality of crypto trading, the budget proposals seek to tax this at 30% on a flat rate basis without allowing you deduction for expenses, without allowing set off of losses. In a manner of speaking, it's almost equated to the taxation of an illegal business, because for an illegal business also, explanation 1 to section 37(1) disallows expenditure incurred. So basically the income would be taxed on gross basis. So having said that, I think the question that you raised on cost of asset, which is self-generated, I think will have no cost. There is no basis or there is no provision in the statute to impute any cost. So I would tend to take the view that in that situation, if Amitabh Bachchan is to sell something that he has originally created, there will be no cost or there will be no imputation for the time that he has spent in creating that arrangement. So that is, I think, the first aspect. Second, you mentioned about the trading on the crypto exchanges and how will actually the deduction of tax at source under 194(s) happen. There are practical challenges around it. The government has kept to itself the power to make rules, and one is reading in the press that rules will come out before 1st April in order to give effect to the proposed section 194(s). But you are right that the crypto exchange is only a platform. The crypto exchange is only facilitating trading. There may be transactions that happen on the exchange where you as a purchaser may not know the seller. So from whose income will you deduct tax or withhold tax? Clearly that person is not identified. At the same time, the crypto exchange would say that I am only a fiduciary, I am only a trustee. So
Yes.
there can be no obligation imposed on me to withhold tax from out of this payment that is transacted between two parties. I only collect from the buyer and I will make it over to the purchaser. So in that process, this obligation cannot be fastened on the crypto exchange. I would think that the government would do well to replace this 194(s) with something like the STT.
Yeah.
In which case the transaction will suffer tax at that level, and you don't have to go around identifying the buyer and the seller. This is almost impossible to implement. There are people say that there are also challenges of what is the quantum on which you deduct. What is the income that you determine? Because I am told that if you trade in foreign currency, which is possibly also permissible, or you have purchased a cryptocurrency in foreign currency. Now, what is the currency that you will use to convert the gain? Again, there are no rules that are prescribed. We are hoping that, when the government says that they'll notify the rules from 1st April, all these aspects will be taken care. At the moment, these are all nebulous.
Yes.
And if things stand as they are, there will be practical challenges and difficulties in implementing this tedious obligation which is fastened on to the purchaser.
Okay. So,
If I may just add here, Sanjeev ji and Ajay ji, I think considering that this is a very technical topic, what we should plan and are in the process of planning is a discussion with a person who understands
Yes.
crypto very well.
Yes.
So I think that could be our next in our series of webinar where we can have an expert talk on this, and then we threadbare discuss the
Sure,
the
sure.
questions
I
that
think
we
that'll be
raised.
very necessary to understand the implications around it.
That's correct.
I fully appreciate that.
Beginning
Yeah.
with an understanding of what actually are,
Right.
what are we dealing with?
Otherwise, from what little I know, all that I know is there are some super macro computers sitting in Iceland where the weather is, cold almost throughout the year. They need huge costs in terms of air conditioning for 24 hours, and there are people mining these on the computers.
Yes.
Not that I understand,
Absolutely.
but this is what I am told.
Ah.
So if you are lucky, you may mine a cryptocurrency.
Yeah.
Yes. And in fact, that's a very valid question. What will happen as you said, like in case of self-generated assets, what will be the
Yeah.
tax liability? And I think, you mentioned about STT. Probably the government doesn't want to go that route because in that case, it will classify it as an equity, and then,
No,
oil.
not equity. You can bring something on parallel.
Yeah, on
Something on
parallel, correct.
parity.
Something
Maybe
like
a similar levy.
Yeah.
Yeah.
A transaction tax on, yeah.
I think Abhishek can enlighten from the indirect
Yes, I
tax
was going to,
point.
I was going
Yeah,
to,
he
do,
should-
I
he
was going to
should-
just say that. I was just
Yeah.
going to say that. Abhishek, if you can come in.
Dr. Punia joined in. So,
Sure. Thanks, Sanjeev. I've joined in. I'm listening in. Go ahead. I have nothing much to add from what Ajay has already stated. The only thing is, I'm drawing your attention back to also there was a detailed questioning which was done from the Revenue Secretary and the Finance Secretary post-budget on the same issue, whether by taxing crypto are we legitimizing the transactions in it. And they were very categorical in responding to that.
Yes.
That we are in no way saying that the dealings and the transactions in crypto are legitimate. I am only picking up my right to tax. And at least the judicial history goes back to Pyara Singh's judgment, which always said so till we brought the amendment that even income earned from criminal activity is taxable under the Income Tax Act.
Right.
So I think Ajay has stated the issue in absolute crystal clear terms, as he normally does, that there is no legitimacy being granted to this, but there is a lot of confusion as to how are we going to tax it and what is going to be the exact amount of tax. Thanks. Thank you.
Yeah, Abhishek.
So I think, thanks for that. I think before we talk about the tax implications on cryptocurrencies, we must understand that these all virtual digital assets are based on a blockchain technology. And this entire gamut of discussion could be divided by examining these into two buckets. One is the cryptocurrencies, and the other one is the non-fungible tokens. And both are different. And when the government, the legislation intends to talk about the cost of acquisition, that will be applicable only to the virtual currencies and not to the non-fungible tokens. So virtual currencies, we all know, are all of these Bitcoins and so on and so forth. But what are these non-fungible tokens? These non-fungible tokens, I can explain with 3 examples. So for example, I have a painting. I want to give the non-fungible token of that painting. And when I give that right to someone, that right entails that person to visit my gallery and have an exclusive vision to that painting with his friends and so on and so forth. So I get an exclusive right. That could be for something like a painting, but the ownership of that painting doesn't change. It's just the right to access, which in this example is relevant. Second example could be that there is an NFT for a house in Miami. Now, if I buy that non-fungible token for that house in Miami, I get the access to stay in that property, let's say for 5 days in a year. And I get that through a NFT. Now, I am not the sole owner of that property, but I have a right in some sense to that property. The value of that property may increase or decrease as the value of any asset would increase or decrease. And hence the value of my NFT would also increase or decrease, which will thereafter be also exchangeable or tradable. So that's with respect to the property. Third could be very interesting. For example, the government of India wants to have NFTs for Taj Mahal. They come out with NFTs and they say that the cost of Taj Mahal today is 20,000 trillion. And we want to issue 1 lakh NFTs. So which means that the ownership of the Taj Mahal doesn't change, but you get an exclusive right. So for instance, that NFT could get you a right that on a particular day, you could get entry, exclusive entry from some particular gate and so on and so forth. The value of Taj Mahal could increase or decrease over the period of time. And hence your NFT value will also increase or decrease over the period of time. So what I understand today, as far as these cost of assets or cost of acquisition, etc. is concerned, the deduction is applicable for virtual currencies because these are being traded on exchange. So all that taxability, etc., etc. But now what happens in case of NFTs, how well they are regulated and how they are taxed for both direct tax and indirect tax remains a question mark. Because when we talk about the supply under GST, the supply includes goods and services. And the definition of services, which is also mentioned in the Constitution, says services is anything apart from goods. So interestingly, it gets covered. But the most important aspect is, there are 2 aspects actually. One fine aspect is that are these actionable claims? And if these are actionable claims, then these are excluded both from the definition of goods and services and hence no GST on that. Which is very interesting and which will certainly go to the court when it comes to applicability of GST on these virtual digital assets. The second related aspect is that how would you value this in terms of the supply? So if I buy Bitcoin for $10,000 and I sell Bitcoin the same because it's all being tracked to the blockchain and I sell that for $12,000. So the question is whether the supply will be taxed at 12%, which is my gross value of sale, because otherwise all supplies are taxed at the gross value. Or will it be taxed only for the differential amount? Now, if it is taxed at the gross value, then the business dries up here. Nobody will buy a sale here because who will pay 18 or 28%? And there is a high likelihood that they would place it under 28%. And if that happens, then I think people would rather transact in cryptocurrencies from their overseas account, buy through the overseas exchanges, because several of these exchanges who are operating in India have also gone out. And hence, nothing gets supplied in India. So the buy-sell transaction happens outside of India, in an exchange outside of India, from the bank account outside of India, through legitimate funds outside of India. So I think that will be really harsh. And I think that's the need that, that's why industry today is seeking. I've done a lot of research on this entire topic, like which are dozen of parties involved in cryptocurrencies and what are these NFTs and how these are generated and so on and so forth. And the government today is only intending to tax the transactions only from the perspective of transfer, etc., both from the direct tax side and the indirect tax side. But I think Mr. Vora very rightly pointed out the implications would be different for different players. So what happens to exchanges? What happens to miners? What happens to those services providers who are providing these wallets? What happens to those activities which are just being used for facilitation? Because we know for a fact that there is huge amount of electricity which is required. And there are these providers who provide just those facilities. And they in turn get the currencies to provide that. So everything is happening in currency. So for mining, you get that. For generation of electricity, you get that, and so on and so forth. So I think it's a good beginning, but it must be regulated, and it must not be that harsh that it encourages people to transact it from outside of India. So I think that's my take on it.
Sanjeev, with your permission, I have some questions for Abhishek.
Yes, sir.
Abhishek, you mentioned about the painting. So that access to the vision or viewing the painting. Now, one doesn't necessarily have to be the painter. I could just be owning the painting. Huh? Is that correct?
Absolutely right, sir. Absolutely right, sir. So you could own a painting.
आपको अपनी पेंटिंग की फिक्र पड़ती है जो
No, no, no,
पीछे
no.
है।
मैं तो दूसरी बात कर रहा हूँ. I am going to monetize. मैं कोई अगर opinion लिख रहा हूँ, I am going to ask him. उसका मैं NFT create कर देता हूँ.
Right, sir.
हाँ? Possible है?
Right.
मतलब going
Right,
forward
sir.
तो फिर.
In fact, sir, you would not believe that today the kids, they play with those cartoon characters, etc. Those are sold through NFTs today. Even the
Aditya,
music
my
albums-
suggestion to you will be, this is actually the subject of a full-fledged webinar. Believe me, no, there are a lot of intricacies around it.
Absolutely.
There are a lot of
No,
intricacies.
no, lot of
Absolutely.
intricacies, both on direct and indirect tax.
Both sides, sir.
From what is coming out from you, not just, so therefore understanding this world of cryptocurrency and the NFTs.
I
I
can
think there are
explain
many
everything on
challenges.
the transaction side. You can explain us everything on the tax side.
No, I think that is, understanding the transaction first is paramount.
Yes.
Before you
Absolutely
can
right.
opine on the implications under any of the regimes. I
Absolutely.
think that is very important. Somebody who understand this.
Absolutely right.
Ashwini Kumar, I'm sure, has got ideas on, what NFTs he can create.
Right.
I don't want to elaborate further. I know because there is some.
Hidden agenda.
Yes.
Right, sir. Thanks. Sir.
I think with everybody's permission, we can now move on because it's a very engaging topic, and I think we start discussing it, we can spend hours and hours together. So I think
But I think that's the new world. Really, that's the new world.
it's absolutely the new world.
Yeah.
The digital world, we'll very soon have a central bank digital currency. So that's the, we'll need to kind of educate ourselves with that.
I think
Right.
Mr. Punya is currently sitting on a war chest. He will soon convert it into digital currency as BCCI head.
No, in fact, what Sanjeeva is raising, the point is very fundamental. As a student of economics, I must say that, this whole thing is raising questions on what is sovereign money. And that is what the digital rupee, which they are introducing, is basically talking about.
Right.
Is it going to be a store of value alone? Is it going to be a medium of exchange? What is going to be its acceptability? Whether the sovereign governments and powers, the state is going to give its right to issue currency also. Because when we define state's power,
The issues that you've raised and trying to understand, it gives us a sense of incompleteness and kind of illiteracy.
those are issues which are completely fundamental to this whole debate. So at times I can appreciate the uncertainty or the kind of doubt which the government authorities right now are articulating openly, because it is not a settled thing even among the states or internationally.
Sure.
Where are we going? Is the sovereign state ready to give up its right to issue currency? And it is one of the three things like defense, currency, and foreign relations. Those are the three defining characters of a state. So we are reaching here, Sanjeev. I'm glad that you're raising these points, because these are very fundamental points which go much beyond tax or our competence here.
Right.
And I'm not belittling my fellow panelists or myself, but much beyond us.
Yeah. Thank you so much, sir. So I think we can now move on. So yeah, there's a small change in section 68. I'll just make a passing reference to that. Now the onus under section 68 to prove the genuineness of the creditor and his identity and creditworthiness, which so far it seemed to extend to the source was required to be proved only in the case of share capital, share application money, and share premium. That has been extended to cover loans and borrowings as well. They're going to create a big problem for people who are taking loans from, private loans, from private money lenders. So they will have to now kind of do the entire exercise, do the entire, kind of due diligence with respect to prove the source of the loans which are received by them. I think I won't deliberate too much on this further, and with everybody's permission, go ahead.
There is one question, Sanjeev ji, from Mr. Rajkumar Agrawal. I think if you can just take it here. He says, I think you've answered it in part, that please explain whether it will apply if taken loan from taken a loan. His second question is, from which financial year it will be applicable?
I think the proposed amendment, Ajay ji can enlighten me more on this, but it's applicable.
It is from 1st of April 23.
Yeah, so that means assessment year 23-24. And being a substantive amendment, casting a further burden on the SSC, it should not be treated to be retrospective in nature.
Yeah. That's right. That's right.
So, thank you, sir. Thank you. So, moving on, the next topic is something which is, I think, like, maybe I could say path-breaking, something very radical in this budget. And as we were discussing internally, it kind of has could have a wide impact. It's the introduction of a new section 139A to enable an assessee to file an updated return within 24 months from the end of the relevant assessment year. So far, an assessee had an option to file a regular return under section 139(1), or a belated return, or an option to rectify any error there, or to file a curative return to correct a defective return earlier. And the option to file a belated return or to rectify the return was a very limited time frame, for a couple of months from the last date on which the return could be filed. So the ability to utilize such kind of an option was very limited. So I think primarily with a view to mine the huge database that the government has at its disposal, and to enable SSCs to kind of correct any mistakes or errors, or to come clean on their various incomes which they forgot to file the original return when filing the original return. A new section 139A 8A is proposed to be introduced, providing SSCs an opportunity to file an updated return, which will update the return already filed by him earlier. Now, so far so good. The option is available. You have an option to file an updated return. But herein lies the catch. There are a couple of restrictions, couple of caveats subject to which the return can be filed. The updated return cannot be a return of loss. Now the question here arises is, if I already filed a return of loss earlier and I intend to reduce the loss, whether the option to file an updated return is available. And rightly so, it cannot result in decreasing the tax liability or result in a refund or an increase in the refund. I must just add in passing that while filing the updated return, the assessee would be required to pay the regular tax, and all the interest will be recomputed. He will be liable to claim all the relevant tax credits, TDS, any other tax credits under Section 9 under Double Taxation Avoidance Agreement, foreign tax credits. But he cannot increase the refund, or he cannot ask for a refund when it already been, which was not claimed in the original return of income. Apart from that, Section 140B, which is proposed to be introduced, also lays down a further liability for him to pay a 25% additional tax if the return is filed within 1 year from the end of the assessment year, and 50% additional tax if the return is filed within 2 years. Now, there are further exclusions. Assessee has an option to file an updated return only once. When an updated return has been filed, he cannot again proceed to update the updated return. So updated return, you have to be very careful while filing the return. In cases which have been subject to search, survey, or requisition, or on the corresponding action has been initiated, they are precluded from the option of filing updated return. Where in notice has been issued that things are sealed or requisitioned in such as books, jewelry, documents, information belong to such person, they are that person is again prohibited from filing the updated return. And lastly, more importantly, in a case where assessment, reassessment, or recomputation revision proceedings are pending or have been completed. Now, I'll just take a couple of minutes here. Notices for selection of scrutiny can be taken up it can be issued within 3 months from the assessment of end of the assessment year. And within a period of 2 years, assessments in most cases would have been completed. So once the notice has been issued, the wording seems to suggest that assessment would be pending. They will not be eligible to file an updated return. So effectively, this provision excludes many corporate cases and other cases which are selected for scrutiny from the option of filing updated return. Maybe that is something the government would have to look at while moving the amendments to the Finance Act. Maybe by way of increasing the punitive tax, the 140B tax, some option could be provided, some caveats could be put in to enable assessees to file updated returns in such cases. Even otherwise, where assessments have been completed, whereafter the utility of this option to file updated returns would kind of stands substantially reduced. Again, where information, the AO has information in respect of the person under the Smuggler and Foreign Exchange Manipulator Act, the Benami Property Act, Money Laundering Act, Black Money Act, and under Section 1990A, wherein double taxation avoidance agreement information has been received from other countries or territories, or where any prosecution has been initiated under Section 275A to Section 280, they would be excluded from the option to file updated returns. Now, as already mentioned, I've already raised certain issues with respect to assessments being pending, notices having been issued, assessments having been concluded, they've been precluded. The question arises whether a filing of an updated return would be treated as a voluntary compliance and with corresponding implication of penalty. And the second issue, which to my mind, which I've already raised earlier, is whether updated return can be fined when there is a reduction of loss. Just moving on from this issue, is this provision a very welcome one, that on the face of it, filing of updated returns giving another option to an assessee to come clean, but whether it is really justified on the canons of equity and it's more of a revenue generating measure, or I may put it, is it kind of a permanent income disclosure scheme, which has been put into place whereby to enable assessees to opt thereof? So that is something I'd like Dr. Punia and Mr. Ajay Vora to give their views on, and plus, as usual, whatever that may come to their mind. I think we have very little time, so we'll, and we have one or two important issues thereafter. So I think Mr. Ajay Vora and Mr. Punia on this issue, please.
I think Dr. Punia would like to come in.
No, Ajay, you start. I'll come in later.
So basically, I think Sanjeev, while you raised this question of whether this is like a permanent disclosure scheme, I think the objective is laudable. Rather than the government going after assessees, issuing notices for reassessment, and then this getting into litigation, and thereafter the assessee, assuming the 148 proceedings are to go on, may be saddled with taxes, penalties, and interest. So I would think that to that extent, it is a welcome step. But practically speaking, there is a dampener when you say that assessees whose case assessment is pending are barred from availing this facility of an updated return. Now, as you very rightly said, a scrutiny notice is issued within a certain time of the close of the assessment year, and then the assessment is normally finalized. And the updated return, you have 2 years from the end of the assessment year to file an updated return. So if a scrutiny notice is received, that person is prohibited from availing the benefit of filing an updated return. Now, merely because you've received a notice, can you say the assessment is pending? Now, you have similar provisions under the Authority for Advance Ruling, that chapter in the Income Tax Act. And the authority had ruled on several occasions that merely because a notice is issued and a standard questionnaire is issued, that does not mean the assessment is pending, or the issue is, in that case, the issue is pending in assessment. Now, this will give rise to disputes as to at what stage can it be said that the assessment is pending if the assessee decides to avail of the facility of filing an updated return. I think that's one question. The second is, the government would do well to clarify that if a person files an updated return then in that situation, that income that is disclosed, which is in a way admitted income, cannot be the subject matter of penalty. You will need amendment specifically in the act to say that penalty would be computed in the case of such an assessee, not with reference to the return originally filed, but including the income disclosed in the updated return. Otherwise, I think it may serve as a check on many people wanting to avail of the facility of filing an updated return. So those are my two quick comments on this.
Dr. Punia, please.
Sure.
I think you're muted, sir.
Unmute. Okay. Yeah, I think that's a very good summary which both Sanjeeva and Rajesh has given. Let me first put it in a context in which it is kind of thought about. You know, when the whole faceless scheme discussion was taking place, and I'm kind of picking up from my experience of working there, you know, the emphasis always was on how can we ensure better voluntary compliance by the taxpayer. There is kind of a realization from the side of the government that it is not possible for us to kind of go after every possible omission or commission. We must give as many opportunities as possible for the taxpayer to come clean. And you know, if you go and read the tax research literature, then it is very clear. Tax compliance is a function of the potential reach of the tax administrator to reach any imprint of financial transaction that I have left. So it is only the potential which should be recognized by the taxpayers to come clean. So it can happen that in I missed out on some information. And the other thinking was that we must make a very clear distinction between omissions, acts of omission and acts of commission. Acts of omission, we must give an opportunity to the taxpayer to come clean, to voluntarily comply with it. Acts of commission may be treated separately, and then all the visitation of penalty and prosecution can come about. So, Sanjeeva, the points which you are raising is an attempt in some ways. I'm not saying it's a good or a perfect attempt. It is an attempt to distinguish between the acts of omission and commission.
Okay.
So much better job can be done. And I think Ajayji's suggestions on those are very clear, that we should clarify those things, that, you know, this is something which happened unintentionally, and this is something which I have acted with intention. And the law should clearly lay out in as clear a language as possible. And all those acts of omission ought to be given an opportunity to come clean, because then it fits in with what the overall scheme is, the structure, the tax administration we are moving to. If the annual information statement, if you see from what we have moved on, that is what the intention is, that before filing your tax return, there is an honest exchange of information from both sides. And the idea is that whatever is the income embedded in those transactions get reflected properly in the tax return. Our whole risk analysis, I must say, we are from the departmental side, there is an attempt to refine the risk analysis so that the estimation of embedded income in financial transaction is much better than what it is right now. So that is a skill set which, again, the government side is learning. So it is a very good move, as both of you put it. But as usual, it is the first initial step being taken. I'm sure the better clarifications will come on the whole legislation, and we will move to a regimen which is far more based on voluntary tax compliance, rather than, you know, income tax department running after persons with minor infractions, which could be pure a slip of mind.
Right.
So that is my little bit on.
I think, Sanjeev, we can say this is a step towards bridging the trust deficit.
Yeah.
Yep.
I think that's a.
I'll talk about that bridging the trust deficit when we talk about faceless appeals and what Dr. Punia had commented a couple of months back.
Right.
So moving on, thank you very much.
Before we just move forward, Sanjeev ji, just one quick question which is appearing on our Q&A posed by Mr. Rajesh Jha. is that whether updated return can be filed in response to a notice under section 148A. If Mr. Vora would like to take a swing at it.
No. Once you get the notice, the assessment is pending or the reassessment is pending.
So
Yeah.
Your question is the 148 notice you are assuming comes within the 2 years from before the end of the assessment year. Is that a correct understanding?
That is correct.
yeah,
So the notice itself will result in the assessment becoming pending.
yeah.
Right.
Okay, moving on. I think we have a couple of topics, but I think we'll quickly switch on to something which has altered the entire SSC department interface. We'll talk about faceless assessments, and who better can talk about this than Mr. Punia? We'll have an expert view on the subject. But I'll just quickly run through the changes proposed in the faceless assessment scheme without in any manner deliberating on that, because we'd like to hear what Dr. Punia and Mr. Ajay Vora have to say on the issue. The scope of faceless assessment proceedings has been expanded to cover reassessment under section 147. Earlier on, the assessment units, which are a part of the faceless assessment scheme, were to facilitate the conduct of the assessment process. But now they will be conducted by the assessing officer, which shall essentially mean the AU. So meaning to say all the relevant activities will be conducted by the AU itself, and not be mere act as the mere facilitator. The scope of technical assistance has been further defined. I'll quickly rush through because I think it's already 4:35 and Mr. Ajay Vora has to leave at another couple of minutes. Something which was in a vacuum earlier was the power to the manner in which the provision of section 142(2)A would be invoked in case of a special audit. Now, powers have been given to the assessment unit the assessing officer to order a special unit, whereafter the proceeding will stand transferred to the jurisdictional assessing officer to facilitate conduct of the the special audit. And the assessment unit, technical unit, verification unit, and the review unit have been defined to mean the assessing officer itself. Now, a review report would be dealt with by the original assessment unit, as opposed to earlier where it was supposed to go to another assessment unit, which can accept or reject the modification proposed after recording the reasons. Opportunity of hearing, which was discretionary earlier, and the denial of which led to a whole lot of litigation on ground of violation of principle of natural justice, has been made mandatory. The provisions of section 144(b)(9), making compliance of provision of faceless scheme mandatory, have been done away with retrospectively. Now, there's the litigation on this issue of compliance with the provision of section 144(b) was something which had got embroiled in a quagmire of litigation. So that has been sought to be done away mandatory with respect retrospectively from 1/4/2021. Now, this being the case, I'd like to have the views of both the esteemed panelists on the issue. Just one comment I'd like to make. Dr. Punia had a couple of months back written an article on how the faceless assessment regime had transformed the trust between the assessees and the department from being mere relational to transactional, and how it had termed it as a broad leap, as a bold leap. Now, given that, what is his experience of the actual functioning of this regime, and how do these proposed amendments dovetail into what his vision was? And having helmed that unit for a long time and being a part of its incubation, how would he view that? And of course, Mr. Ajay Vora's views. I think we can hear Mr. Ajay Vora first because he has to leave. Thereafter, we can have Dr. Punia on the topic.
Yeah, I have limited comments. I can say that this is a step in the right direction to have this faceless assessment where the interaction between the tax gatherer and the tax payer is minimized. But from practical experience, there have been teething issues with the implementation of the faceless assessment procedure, especially in some metros that we see, where either there was inadequate opportunity given or there was no opportunity given. The procedure that was outlined in section 144B was not followed of making available a show cause notice along with the draft order, or even if the assessee asked for an opportunity of hearing, hearing was denied and the order was passed along with the demand notice and so on. So I think those were initial days, and the government would do well to put in place necessary steps to ensure that the procedure is scrupulously complied with. And there cannot be any sacrifice of the principles of natural justice, even if you go through a faceless assessment procedure, which is now sought to be rectified. So the disputes that came in before the courts, I think the government has done well to take care of those issues and have incorporated them in this new revised procedure for faceless assessment. The only thing that I would want to comment is that one abolition of section 144B9, which said that if an assessment was made without following the procedure in that section, the assessment was non-est. I had thought at that time that this was one provision which was unique in the sense that the government was seeking to take ownership for any lapses that happened in complying with the procedure, which resulted in the assessment being quashed as null and void. Although the courts were initially reluctant and hesitant to, quash an assessment and merely set aside the assessment, giving opportunity to the assessing officer to make a fresh assessment, even though limitation may have expired in that situation. But there were one or two cases before the High Court where we were stressing on the applicability of section 144B9 to say that you need to quash the assessment and let the department take its remedy in law if otherwise available. Now that provision has been done away with, but I have no regrets on the provision being taken away, so long as the department would be making amends by ensuring that adequate opportunity of hearing is afforded to a taxpayer. The taxpayer is confronted with the proposed adjustments, proposed additions, and he responds whatever view ultimately is taken is besides the point. So the process and the procedure of assessment is scrupulously complied with on both sides to result in a fair judicious assessment. And again, one is not to be bogged down by the additions or disallowances that may be made in the assessment. It will be the subject matter of further appeal on the merits of the matter. So I think all in all, this procedure of faceless assessment is, I would say, a welcome step. And I would think that in times to come, this will help reduce the interface between the tax administration and the taxpayer, which is possibly a step in the right direction. Thank you.
Thank you, sir.
Yeah, thanks. I can come in a little bit. So I'm glad that I heard views of Ajayji before speaking, because, let me start by making my bias clear. I am a little biased because, I had the privilege of heading this scheme in its initial phase. So let me begin by just saying laying out a couple of propositions right there. The first is that let's be very clear, and Sanjeeva, you raised this point that how faceless has been expanded. The thinking on the side of the state and the government is very clear. Faceless is first, here to stay. It's not going anywhere.
Yeah.
Second is faceless is our future. In fact, every bit of assessment slowly is going to move to a faceless thing. So the whole idea that assessment cannot happen without face-to-face interaction, we have to kind of get over it. And it is going to be there to stay, and it is going to encompass the whole of the assessment process in the tax department. And I read the signs in the wind, as they say it. The scheme itself comes from a very clear thinking on this, which was articulated by the Honorable Prime Minister in the Rajaswa Gyan Singham in 2017. And he's very clear in his mind that this is implementable and it will give us good dividends in the long run. And to some extent, in the government side, it is being read that the current year's buoyancy in tax and the jump which has come in the tax is to some extent a result of better compliance, which is partly on account of faceless interaction, our reliance more on transactional trust and digital data rather than on personal interaction. So it seems to be taken as a vindication of early vindication of what has been set in motion, which you rightly pointed out and which I had kind of hinted, that we are moving from a relational trust to a transactional trust. And that is a move not just in tax administration, but that is a move which is happening all around the world. In fact, what Abhishek had raised the point, even in cryptocurrencies and Bitcoins, if you peel the layers and you read the original theoretical paper, which is attributed to Satoshi Nakamoto, and Satoshi Nakamoto's paper says what? Payment system based on cryptographic proof instead of trust. And cryptographic proof is nothing but transactional belief and trust in those persons with whom you have repeated transactions. And if anybody who betrays that trust, the group itself will impose costs on him or her. So that is the basic thinking which is there behind most of the new interactive, financial interactive transactions. So not just in tax administration. So I think, as Ajayji pointed out, it is a very welcome step where we are moving from the old system where the tax was determined by a fixed jurisdiction, by an officer who had local knowledge, who applied the law, looked at the financial data, and framed a tax assessment. Rather than that, now we will go purely on the transactional data. We will look at the financial transaction data. We will look at what is the income component embedded in it, and try and make a group-based and based on close interaction of exchange of information. And as Ajayji pointed out repeatedly, the belief from the government side was never and would never be to deny an opportunity of natural justice. And as Sanjeeva, you also pointed out, in fact, they have brought about a change also at the same time when they have taken away subclause 9, they have made the video conferencing right. They have replaced may with shall. So as and when you ask for an opportunity, it is the duty of the tax department to provide you a chance of video conferencing. So there is a thought that yes, we faltered in providing adequate opportunity of representation to the taxpayers. We must give it to them, but we are not going to give it to them in an interpersonal, open physical interaction, but it is going to be given through video conferencing. And not only that, if you see that the Act itself mandates that the income tax office will provide this kind of a facility for those taxpayers who cannot on their own have video conference. So there is an increasing emphasis on principle of natural justice from the departmental side. And this point is very well taken. I only wish that they had not taken away this clause 9 retrospectively, like in our honorable finance ministers have given a kind of an assurance before different forums that we will not be touching the certainty of law and process which is there in the previous years. And why go there? As I said, it is probably guided by that those assessments which we have lost because we failed to give adequate opportunity, we must recoup the tax from those taxpayers again. According to me, that is a little bit of noise of data. And like any good statistician will tell you, ignore the noise in the data. Look at the substantive data. We have taken such a bold step. This is a minor cost of implementation. We could have digested it very easily and moved forward rather than going in for a retrospective kind of an amendment in that. So I think the idea is very clear that, look, we will trust the digital data more than the interpersonal relationships. We will devise better means of estimating income, which is embedded in the financial transactions. We will provide facilities of video conferencing so that those persons who want to have an opportunity to canvass their views must get a chance. But then it imposes, according to me, a very high cost on both the department as well as the professionals.
Correct.
Professionals, according to me, have to really start concentrating on how can they convey in words what was previously conveyed through interpersonal interaction, read the body language, read the gestures, read the eyes. Now all that is gone. So you have to articulate and become as convincing as you can be through your written submissions.
Okay.
So our skill set, which was first to read the body language, develop a personal interaction, has to be replaced by a far greater emphasis on our writing skills. And critical writing is both an art and a tremendous work of hard work. As I must share from my experience of doing a doctorate from a good private research university in US. My professor there used to say that, Pushpinder, if you have come to me with a draft which you haven't redone 7 times, then don't even put up to me. So if you have not gone through 7 iterations, it is not worth, it does not represent your real clear thinking. So go through those iterations. Otherwise, what our idea is that we have a certain degree of verbosity in our articulation, written articulation. That verbosity has to be taken out, and the core of the matter will need to be put across in the skill set. And from the departmental side, I say the cost is first. We need to learn, and we are learning that it is not so simple to operate in a digital world. It is not so simple to estimate the actual income which lies embedded in the financial transactions. And all those are, again, skills which need to be learned and which we are struggling on our side. But there are a couple of other things, Sanjeev, which I must say that which, again, show me a lot of hope that we are moving in the right direction. Our first year of implementation of the scheme had shown that what we had visualized, that people will be interacting with us.
I think Mr. Ajay Vora has to leave,
Yeah. Okay.
Yeah. Huh?
I just want to add, I can't help but add to what Dr. Punya said about, 7 edits in a draft. To our young professionals who are here on your webinar, I think that's the message.
Yes.
That you really need to put in your submissions. You can't possibly look at 40 pages and think that the tax department will read the 40 pages. The art is in crystallizing your thoughts into readable form. And clearly, as you go higher and higher in the Supreme Court, if the judge is liberal, he will allow you 2 pages. Otherwise, he wants you to crystallize everything in 1 page. The High Court might say 3 to 5. The tribunal might say, 8 to 10. So that's the art that Dr. Punya is talking about. And I think that's something that the youngsters and the professionals need to imbibe today. That verbosity has to be given up in exchange for making a legible submission, limited to the point and which has the crux of the issue. So I think that's the point that I thought I would just want to add, and as a message to people who are assembled in your webinar today.
Thank you. Very topical, sir. Very topical.
I think Ajay ji can leave. Dr. Punya can continue.
Yeah. Thank you, Ajay ji, for
thanks, Punya Sahab. My apologies.
Thank you, Ajay ji.
Yeah, missing out on the interaction.
Thank you.
Thank you, Ashwini ji, and thank you, Sanjeev and Aditya, for this opportunity.
Thank you, Ajay ji, for taking out your time.
Thank you.
Thank you, Abhishek. Thank you. We'll interact with you sometime.
Thank you, sir. Thank you so much.
Yeah, sure. So I can continue from the point which I was making, that yes, the critical writing aspect is one, and the positive signs which I read. I was giving you an example when first year when we implemented our scheme. We thought, the best way of interacting with public is that through the email and through the portal. But what we realized after a while is that in India, as yet, email and portal interactions are not so contemporaneous. People don't People don't even look at their email for a while. People don't go to the income tax portal. And where do they interact most often? The most often used implement right now is the mobile phone. And if you see in the current scheme of things, there is a specific mention out there that all the relevant information increasingly is going to be made available by the income tax department through the mobile application. And all the notices and all which are issued will have a real-time reminder coming to you through a mobile application. So the idea is that what is really striking for me is that the government is getting alive to the problems which the taxpayers are facing, number one, in interacting with us, and secondly, in correcting the mistakes in our own thinking. Our own thinking was email and portal are very good, and we can get by with it. And then we realize, no, mobile phone is so much better. So how can we interact with the taxpayers on a mobile telephone? You may not like a reminder by a tax department on a mobile. I'm sure it's not going to be a very welcome thing, but you will start getting it in the near future. And one aspect, Sanjeeva, which you raised out there, I want to deal with it in a little bit of detail. That is the technical unit. A very positive change which was sought to be brought about in the faceless assessment is that we would try and restrict repeated litigation which arises out of some specific accounting or legal disputes. And our data at that time, and I can share, it was a random sample data which we had collected. We had found that if you identify 20 legal or accounting issues, then more than 80% of tax litigation out of assessments can be defined in and around those issues. So if those 20 issues can be debated in the technical unit and a consensus is arrived and evolved, which then gets communicated to the assessment unit that on this issue, like you can say a 14A issue, say for instance, or at times even section 68 issues or issues like that, then that can be communicated to all the assessment units across the country, and one consistent stand is taken, so that we do not have repeated, tangential interpretations on the same accounting or the same legal issues. So the technical unit, unfortunately, as yet has not come up to those standards. And it is my suggestion through this forum is that slowly as we go forward, I'm sure the technical unit is going to evolve into something really broader, where some chartered accountants, some persons from the Law and Justice Ministry come and sit, so that there can be some quick settlement of those repeated litigations which we have on certain accounting or legal issues. So the technical unit is a very, very important component of the faceless assessment scheme, and its role is going to get very clear in a year or two when it starts functioning in a proper fashion. So those are the few points which I thought I would just highlight to the professionals and the youngsters who are joining in here. I'm open to any questions if anyone needs to ask on that.
Thank you for your very articulate and erudite comments. It opens up a new vista, new avenue. We can start looking at faceless scheme in an entirely new, with a new perspective. So I think we'll have some questions towards as we move on. We had a couple of more issues relating to direct tax, but given the paucity of time, I think we can now move on to the indirect tax segment. And I'll request Aditya and Abhishek to take over from here so that, to cover the areas relating to indirect tax. Sorry for the delay, Abhishek and Aditya,
No problem.
but please carry on. Thank you.
No issues, Sanjeev ji. I think the discussions were so enlightening and so wonderful. And we did get a glimpse of, indirect tax implications while we were discussing our virtual digital assets. So, having heard Mr. Vora, Dr. Punya, all this while, I think there are so many details in the budget which still require more deliberations, and we'll probably need to bucket these into smaller issues and address our audience on them, which we can take up as we go along. Now, coming to indirect tax front, in a very typical style, now GST Council has robbed the budget exercise of the major changes, almost for 4 years, and most changes are presented by the council. Nonetheless, there were a few critical changes that have been brought about. And now with Abhishek, I will try and walk you through these proposals and take his comments as we go along. So under the goods and services tax, one of the key changes that have happened pertain to, now allowing credit to an assessee only to the extent as it is visible in GSTR 2B. Also, what the legislation talks about is doing away with the matching concept that we had started with, which was GSTR 1, 2, and 3. That concept slightly goes away. And it was initially envisaged as a self-assessed tax. And I somehow feel that, have we reverted to a vendor-assessed tax? Because now you need to look at the compliance made by the vendor. Till the time the vendor has not filed his returns. So we need to sort of make sure that he's making the compliances. So on that front, Abhishek, if you can throw some light on this, on the change in this legislation, the way it is proposed, and the ramifications that this may have on the industry, tax professionals, and what is the because now this has got a legal backing, because they're introducing it under Section 16 and introducing Section 38. So love to hear your comments on this.
See, I think there are a couple of thoughts here, Aditya. The first and the foremost is whether credit remains my vested right, and whether Article 300 capital of the Indian Constitution will come into play with respect to these credits. And I say that with full responsibility. As far as the purchaser is concerned, purchaser has done everything in terms of the payment to the vendor for both the consideration and the taxes. Now, this new Form 2B generates a statement, which is something like your Form 26 AS in income tax.
Yep.
And to that extent, everything comes in the system digitally. So, and that's why the reason is there that why they must not have the matching concept today, because you would be able to take the credit only what is there in the statement, which is a good sign for better compliance. But what happens to my rights will remain a question. Now, imagine the purchaser has paid the consideration and the tax to the vendor. I am out of pocket to the extent of 100 plus 18 in this example, let's say 118. The government denies me the credit of 18, for which I have been out of pocket. And the government leaves it right to recover that 18 from the vendor along with interest.
Yes. Interesting.
Now, what happens in this situation is I lose my right because I can take credit only within the stipulated time. So I lose my right to take credit after a while, whereas the government will have its right to recover that money even after several years, and that too with interest.
Right.
Additionally, there is a burden of interest which gets imposed onto me if for some reason I take it and he doesn't pay that. And when he pays that at a later stage, he also pays it along with the interest. So I think somewhere there has to be a reasonable rationale for these provisions. You cannot be that harsh on both the sides. You can be harsh on the side where there is an actual tax default,
Yes.
but not on that side where the tax compliance has been done, payments have been done, and so on and so forth. So I think, Aditya, one is, of course, the constitutional validity of these entire amendment, which will be tested, for sure, which will be tested at some stage. But I think more importantly, from the perspective of a lot of our chartered accountant friends is that, and even the lawyer friends, is that today we must have watertight agreements. All these clauses, supply chain management, payment terms, indemnity clauses in cases of default, and so on and so forth, must come into the contracts. So even if these are smaller contracts, and we were talking about a lot about these contracts, and we'll soon get into the age where there'll be smart contracts, digitally designed contracts, and so on and so forth. So I think the need today is to have such contracts which capture all these payment terms, what happens in cases of default, indemnity not only with respect to the credits, but also with respect to the interest. And these are the important aspects which must be seen today.
Correct. So rightly put, Abhishek, and the couple of other changes that have been made in this bill, which are sort of aligned to what you're saying. And I think the next one that I wanted to discuss was, in fact, the extension of time limits. Where they in the statute they've put in a clause where you can only claim the credits or issue credit notes up to 30th September of the same year, and that time has now been extended to 30th of November. In my opinion, to start with, how can you, the example that you were giving, that I'm already out of pocket, and then let us say I get into a dispute with the other gentleman and he doesn't pay me for up till November, but he promises me to pay, and he keeps on delaying it. I'm at a loss. He has to reverse the credit within 180 days, and I have paid to the government, so the government is earning on both kitties. So while it appears to be something welcome, because this was something that used to bother everybody, that within 6 months I have to reverse, I have to decide whether I need to issue a credit note or not, but at least I think to the extent that some breathing time has been given.
So I think 2 months extension is a welcome move, but I am on a broader principle that could there ever be any time limit for me to avail credit? I mean, and whether the Limitation Act must come into play. And if you read my brand equity decision of Delhi High Court has specifically gone into 3 aspects. One, whether credit is my vested right. Article 300 capital of the Indian Constitution comes into play. And whether period of limitation as per the Limitation Act becomes applicable, because in some cases the limitation is coming through the rules, which is the delegated legislation.
Yep.
So the question is that, is fixation of this time or extension of this time arbitrary?
Mm-hmm.
Are these backed by sound legislative principles and policies? And are these legislative principles and policies going against the provisions of the Constitution or certain statutes such as the Limitation Act?
Yeah.
Those questions will now arise in the indirect tax regime.
Absolutely. Couldn't agree more with you on that. In fact, the age-old decision that we used to read of Daiichi Karkaria, that SENVAT credit is indefeasible. I mean, and it's what you're talking about, a vested right. I think all these provisions are, not relevant for the change that has been made, but relevant from this issue with vis-a-vis availment of credit up to a particular period of time, which sort of violates my basic rights. Moving on, I think another welcome change I would say is that now you can, if you have excess balance lying in one state, a cash balance, it can be used to offset the liability in another state. Earlier, you could do between CGST, SGST, or IGST, but I think this has now been allowed to do interstate, which I would say goes to what we've been trying to say as a one nation, one tax. There's still maybe some nuances, but it at least takes care of certain issues where you've got some liability in one state and it gets utilized in another state.
Certainly, yes. I think this is a welcome one. You may have amounts stuck, or you may have pumped more money through cash ledger in one of these states, but you realize that the sales or supplies are happening from the other state. So you would want to utilize your cash credits there and transfer it to the other registration.
Correct. Moving forward, in terms of other changes, I think is the interest on ITC reversal, which is a retrospective amendment. And though this was a very heated discussion, I think it was discussed in the GST Council, and there were a couple of clarifications that the GST, the interest liability will only be when the credit has been utilized and not availed. So I think to that extent, it puts the litigation at rest. However, because this has been made with a retrospective effect, I have a question that what will happen to those cases where someone has paid interest on availment, and whether I will be entitled to refund, or whether I'll have to approach the courts for getting that refund. And there are some huge costs, huge amounts that are blocked of assessees on this. And I think this will be important to see how the courts take it, because the law, I think, does not specify here that you cannot take a refund of the prior period.
So I think a couple of points here, Aditya.
Yeah.
You have captured it quite well. The first and the foremost is that the amendment comes into place retrospectively.
Yeah.
So which means that at that point of time, when you had paid interest on some liability, but you had the availed balance, which was not utilized, but it was a wrong liability for whatever reasons, the law is amended retrospectively. So today, from the date of the retrospective amendment, you could claim refund of that. That is one. More interestingly, if you see the provisions of Section 50, and I have challenged that provision as well, the benefit kicks in only those cases where there is no investigation.
Mm-hmm.
And if there is investigation, then you are not given the benefit of non-payment of interest if it is not utilized. Now, what I am arguing before Gujarat High Court is that on the first principles itself, where you are saying that it must be both availed and utilized, it must be made applicable to everyone. So there is no intelligible differentia in those cases where the person pays it on its own, or where the person pays it subsequent to any investigation or error being highlighted by any audit committee and so on and so forth. So I think that aspect of interest will remain a subject matter of test before the writ courts.
Right, 100% agree, Abhishek, and I think that will be very interesting to see how it plays out in courts. And as I said again earlier, that this is a very welcome move, because it at least puts to rest this litigation that I have to pay interest only on the utilized amount and not the availed amount. And all those show cause notices sort of go into the get buried. So and thank you again for your comments on this. Moving forward, I think in terms of GST, I think the compliance reforms were these. Then there have been certain changes in the administrative front, and certain rates have been prescribed for. It has been held that license fee for permits will not be which hotels and restaurants pay, will neither be goods or services, and accordingly will not attract RCM, so to say. And in this, they have specifically mentioned that no refund shall be made of tax which has already been collected. And this has also been made effective retrospectively. I cannot come to terms what could be the reason for doing that, because if you're making it retrospective,
Yeah.
right, and then also saying that you will not be entitled to refund, specifically putting a clause to that effect, what do you read of that?
See, I think more importantly, there was a challenge on the constitutionality of such licenses, and it was not restricted to only the alcoholic liquor licenses. But the dispute is also with respect to casino license fees, mining rights fees, and for that matter, even the spectrum charges being paid. The broader question today, Aditya, is that whether there is any quid pro quo, whether these charges are being made applicable as sovereign rights. So when it comes to casino, can you have a different position for the casinos as compared to the alcoholic liquor license? So those are the broader questions, because if such charges are taxed today, then what happens to driving license fee, passport license fee, advanced authorization licensing fees? And today there are disputes all around. So I think to address the issue so that it is settled in courts with respect to the constitutionality, they have actually made this retrospective. But if refund doesn't come, then I think that doesn't serve the purpose. So you are very, very right on that aspect.
Great. And there's a question from Mr. Mahajan, where he asks whether this license fee is related to alcohol for human consumption or it is related to denatured alcohol too.
So basically, this is alcoholic liquor license for human consumption.
Right.
Denatured ethyl alcohol, there is a separate provision because it doesn't fall there. It also comes within the category of GST. It is not excluded from the purview of GST. And we have separate issues with respect to denatured ethyl alcohol, that concessional rate benefit, which is in any case a subject matter of another dispute, because in the transitional regime, that has been basically just copied and pasted.
Yes.
But interestingly, in the recent past, I've got 3 decisions from Bombay High Court, where the court has categorically held that no coercive action must be taken, and this has to be relooked.
Yes. I'm aware of those judgments, Abhishek. I've gone through them. Thank you on this clarification. And I think we'll move forward on the other indirect tax proposals in the Customs Act, which is also very important. I want to deliberate on that because that's very important. And I think the audience here and our clients and professionals will definitely have some insights there. So now the Honorable Supreme Court, in the judgment of Canon India, had held that an officer of the Directorate of Revenue of Intelligence, the DRI, is not a proper officer to conduct investigations, inquiries, and issue SCNs. Now, in the current proposals, the scope has been broadened to define the proper officer, to expressly allow him to and assign him the functions of the officer of customs. And I think this is a common theme that we discussed in the direct tax proposals also, and we've been discussing so far. It is also seek to do this retrospectively. So what happens there? I mean, in terms of the existing, so I think the question can be taken in 2 limbs. One is obviously going forward, what are the implications? And the other is what happens to the ongoing litigation, what happens to the cases where already such notices were issued, where the person, when he issued the notice, was not authorized as per the definition of the statute. Over to you.
I think Sanjeev ji mentioned about that retrospective amendment with respect to 14A in the Income Tax Act. This is something of the similar nature. And I think the government has come into this habit of making these amendments retrospective. I'm already arguing on several retrospective amendments under the GST Act. And during my arguments now, I have created a very specific distinction, which I think in the earlier part of the presentation, Mr. Vora mentioned about the substantive and the procedural aspect. But I have gone a step ahead. And I am now trying to create a distinction between retrospective and retroactive. And we want to go to the court now to say that these retrospective amendments are retroactive. And we'll get a lot of international jurisprudence, etc., also on record.
Very interesting.
To say that why these retroactive amendments are bad in the eyes of law and constitutionally must be struck down. Now understand, in this situation, there is a Canon India decision. There is already a Supreme Court decision to lay down that what is right and what is wrong, and it is settled. Now comes a retrospective amendment, which is in a way retroactive, because whatever has been done in the past also becomes the subject matter of the new provision, defeats the purpose of the Supreme Court decision. So the question which arises is whether this retrospective amendment is good in the eyes of law or not. That is one. Second aspect, Aditya, is that these retrospective amendments must happen only in the rarest of rare cases.
Yes.
Wherein there is some lacuna which has been missed, and the mischief rule as per the Hayden rule comes into play. But this is not that situation. Today, unfortunately, retrospective amendments are coming after we are getting some of the best decisions from the finest judges in the country. If you see brand equity was argued by me for several days, and after that, hundreds and hundreds of decisions relied on brand equity. And then there is a retrospective amendment. That's the other point, that we will argue even on the retrospectivity till the last breath. But then the question which arises is that if the judicial review has happened with respect to even a policy decision for that matter, and the courts have held it to be arbitrary or unreasonable or vague for whatever reason, could you have a retrospective amendment? That will be the real test now for us before different courts. But yes, of course, I have already prepared the writ petition with respect to this, which I'm filing in Chennai. And soon we'll see that, how the courts address this aspect.
Interesting. In fact, there is a question from Mr. Yogesh Rudra. His question is that what happens to the writ petition when the issue is pending before High Court and technically challenged in terms of canon judgment? I think this is exactly what you were just talking about, because it's sort of retroactive, and the courts will have to take cognizance at this, while they will have to take cognizance of this retrospective amendment. I believe, because this is an act which, when it was done, the law was not authorizing that person to take that action. So therefore, I think courts will definitely draw that distinction of what you just spoke about.
So I think very clearly for the pending writ petitions, Aditya, we will have to amend the petition to the extent of the retrospective amendment which has come as well. Because if you want to challenge it holistically, you will not only have to challenge the law, how it was prior to the amendment, but also the retrospectivity. Because now, through the retrospective amendment, the changes have happened. So are these retrospective amendments valid needs to be tested as well.
Yes, and very true. Very true. So moving forward, in terms of the other changes that have taken place in the customs law, and again, because we have a lot of exporters and importers in our region of Punjab and of course all other parts, is the extracting of data or publication of data with respect to the quantity sold by someone, the rate, because we tend to use that as a benchmark for picking up the our competitors' data, what's the pricing and stuff like that. And that has now been made as a punishable offense and a non-cognizable offense with the fine of 50,000 and imprisonment of up to 6 months. So this is something, obviously we want to make our audience aware that we need to be mindful of any such acts. And the thing that we may want to deliberate on is that, is this penal provision on the person publishing it or on the person who is using it?
It is basically on those private companies, etc., who are publishing this. A lot of times this data was used for studies with respect to spatial valuation branch studies, imports with respect to related parties, anti-dumping duties, and a lot of such transactions where comparables were important. A lot of times when these imports from related parties would happen, you need to prove that what are the transaction value with respect to the imports between non-related parties and so on and so forth. So this data was very useful in a lot of situations, but this data was lately misused for several purposes, commercial purposes, and hence the government has today come up with this provision, perhaps a little harsh. Imprisonment is a little harsh, but yes, the intent is that this data must not be made public, and this can be made public only for certain specified commodities or trades where the approval has come from the government.
Right. Great. Absolutely agree. And again, I think this is something that the people around should be aware of, and we need to take cognizance that we don't end up publishing such data which will cause us harm in terms of penal provisions. With that, I think that takes care of most of the changes that were made. I think we've already discussed this, yes. So yes, I think Abhishek, unless you have any other important legislative amendment that I might have missed out, which you want to highlight. But before you do that, I think there's a very interesting comment made by someone, which is Mr. Purushottam Gopalan. He says, with so much limitation under section 16 and 38 for the recipient to take ITC credit, it is better to suggest that a recipient should pay under RCM for all the B2B transactions of the supplier and take credit.
Absolutely, he's making a very valid point. In one of the presentations, I had made that point, that for all B2B, are we moving to a stage when we will soon be under the reverse charge for all B2B?
All B2B.
To make the payment to the vendor for the consideration, make the tax payment under reverse charge for all B2B transactions, take credit.
Yes.
No matching required, no problem of
no revenue leakage. I mean, from the government point of view, there's no revenue leakage then.
And there's no revenue leakage, and all B2C transactions. So wherever you have the registration number, you give the undertaking, and that could be reflected in his GSTR1 that the tax has been paid.
Right. Great. I think we're more or less done. I think we're also on time. We have about 5 minutes. If there's any other comment,
I think there is one question from Amit, but how to adjust ITC in this case?
Yes.
So I think as far as ITC is concerned, the credit will come in any case to the person who would avail that. The only problem will be with respect to the vendor, because vendors' tax liability would reduce.
Right.
And hence what happens to his credit will be a problem.
Correct.
So to that extent, Amit is right, because to that extent, he may have lesser outputs, and this transaction could be more applicable to those cases where his output and input both are B2B on the vendor side. Because if all of his output is under reverse charge, he doesn't pay anything on the output side, and
Yes.
his input tax credit will remain in the book. So this optimal solution for that is that he must be eligible to get the refund of that.
Correct.
So till the time, Amit, he gets the refund of that tax, there is no tax cascading, and also there is no compliance lapse.
Yep. Absolutely. Anyway, I think we're nearing to the end. If there's any, as I asked Abhishek,
I
is there
think
any
there's
other
one-
comment you want to make vis-a-vis any other changes that have taken place? Any other thing that you seem would be important for the
I
audience?
think there is some question from Mr. Vishal Garg.
Sure. Let me just take that up. Please explain how possible in every case of B2B RCM.
See, I think B2B RCM is only the last resort. So, and that is all hypothetical. So today, the debate is between B2B RCM versus the matching concept and versus this 2B reconciliation, which comes in a form of a statement. And could that be made specific only for certain sectors? So I think creating an exception, or personally, I feel that going under the RCM may not solve problem to a very large extent, because there will be tax cascading, and then what will happen is that accumulated credit would require refund. But can the government think about it for certain sectors is the only question.
Right.
Otherwise, this model may not work, because then there'll be a lot of situations with respect to refunds of taxes on the vendor where the accumulation happens.
There is another question, I think, from Mr. Gopi Sharma, CA Gopi Sharma. If Sanjeev ji, you could just
Are there any special benefits to startups in budget for real estate?
Yeah, so I could not find any specific exemption for startups. Only thing for startups under Section 80 IAC, the date for incorporation of companies, the sunset period has been extended from 31st March 22 to 31st March 23 for an eligible startup. For rest, I could not find anything specific.
I think Sanjeev ji, for real estate, TDS provisions, that sector has been hard hit.
Yeah,
We have not been able to take up that topic, but because where they have said that TDS will be deducted on the
Stamp value.
stamp value.
stamp value. And particularly where you are taking, let us say from DLF, we buy a property, what will be the stamp value there? And how do you deduct tax on installments? All these issues are very gray areas, but that is, I think, one area which will hit the real estate transactions.
And even under Section 194 IA, the issue is that the 50C and 43 AC provide you a 10%, safe harbor. So in case your transaction falls within the safe harbor, will Section 194 IA still be attracted? That is another area. So I think we could not cover that, but yes, the issues will arise with respect to real estate, and that, as Ashwini ji rightly pointed out.
Great. Abhishek, there's another question from
Pradnya.
Pradanya Bhagwat, where she's asking that ITC reconciliation to be done with GSTR 2A and 2B both, or only with GSTR 2B going forward?
Going forward, the reconciliation will be done only through GSTR 2B, nothing else.
2B, that's
GSTR
what-
2B will give you the eligible credits which you could basically avail and utilize. And this GSTR 2B will be based on GSTR 1 and 3B of the vendor.
Correct.
So only after he submits the details in GSTR 1 and complies the payment under GSTR 3B, it gets reflected in my GSTR 2B. So 2A has no relevance now, only 2B.
Sure.
And this is without the matching concept. So there will be nothing matching concept now.
I think let us adhere to the time schedule.
Yeah.
Yes, yes. I think we've had a great session. Abhishek, thank you for all your inputs and comments. And with that, I'll request Ashwini ji if you can just make the closing remarks and thank the
No,
panelists.
Thanks a lot,
at
Aditya.
the outset,
Sanjeev ji,
I
and
must express my deep sense of gratitude to all the participants who were with us for this long time, because it is easy to say that we are doing virtually, but it is difficult to sit for such a long time and be so attentive. So my thanks to all the participants, and I must say that we have had a very lively session with Mr. Ajay Vora, Senior Advocate, Dr. Pushpinder Punia, and Mr. Abhishek. So because all these persons in their respective fields are, I without any doubt in my mind and with lot of responsibility, I can say they are great pillars in their respective fields. And to have their presence on this webinar, I think it is really a great benefit to our firm and to all the participants who could spare their time for this webinar. We certainly assure all the participants that we will try to continue with such webinars in times to come. And particularly, as was referred by Mr. Ajay Vora also, that with respect to this cryptocurrency, we can have a separate webinar wherein we can have Mr. Vora, Mr. Abhishek, and some other expert who can talk about this cryptocurrency, because that is going to be the in thing in times to come. So with these words, once again, thanks very much. In fact, all our young team in Ashwini and Associates who were deeply involved in preparation of this presentations, and who without their effort, all these activities cannot be a success. So thanks very much, each one of you.
thank you, Ashwani ji. Thank you, Sanjeev ji, and thanks, Aditya.
Thank you, everybody. Thank you.
Stay
Bye bye.
safe.
Have a great day.
You're most welcome.
Thanks. Have a great weekend.
Sharing to you.